Welcome to Catalyst. I'm Seana Smith alongside Madison Mills, 30 minutes into the U.S. trading day. Let's get into three catalysts that we're watching this hour.
First up, we'll break down the impact of tariffs on the market as investors grapple with growth fears alongside concerns about the S&P 500 hitting the level that it was at during the presidential election.
Plus, how will the new levies impact sectors? We'll discuss the outlook for retailers, autos, and more.
And as CoreWeave files for its IPO, we'll look at how current market conditions are impacting IPOs. Let's take a look at some market headlines to start the hour here, sponsored by Tasty Trade. You're looking at losses across both the S&P 500 and the tech-heavy NASDAQ here, down about 1.5%. Your S&P down 1%. The key level we are testing is 5,700. That is the level that the S&P 500 was at on election day. If we do see the market hitting that 5,700 level into today's close, you'll start to see headlines about the market erasing gains following the presidential election. Let's flip the board over to the bond market here. You're going to continue to see those yields coming in. You've got your 10-year down 4 basis points. We're looking like we're on track for an 8th week of declines in those yields. Interesting to see whether or not we continue to see that momentum that the Trump administration Treasury Secretary Scott Bessent has said that he is looking for on the 10-year, looking to control those yields. We are still seeing that trade continuing. And finally, we got to take a look over at Bitcoin, still seeing those losses. Bitcoin down 6%, that momentary rally off the announcement of the strategic Bitcoin reserve reversing as the week has gone on here.
All right, well, fears of a deepening trade war rattling U.S. markets after China and Canada both announced retaliatory measures. Mexico's president is saying this morning that the country will respond as well to Trump's tariffs, with details to come on Sunday. Retailers adding to worries this morning, Target predicting that tariffs are going to pressure first quarter profit. Best Buy issuing a muted annual sales forecast after warning earlier that tariffs would force electronics retailer to potentially hike prices. Joining us now with more on what Trump's tariffs could mean for Wall Street, we want to bring in Steve Rattner. He's Willett Advisors chairman and CEO. Steve, it's great to talk to you. So let's talk about the disruption that we're seeing play out in the markets right now. Clearly taking a look at the major averages lower here once again today. Maddie was just talking about the fact that one of the critical levels to watch here is a reversal back to the levels that we haven't seen since election day. I guess to what extent do you expect to see some of that disruption play out in the market?
Well, we're seeing it play out in real time. Look, this is not a theoretical discussion anymore. For the last several months, we've had this theoretical debate between economists and people like me who basically think that tariffs are essentially bad for the economy ultimately in the long run because of the deglobalization, raising costs and so forth. And now that the president's actually imposed them, the markets are speaking. And so no longer can the president say, well, all you economists are all just crazy. This is the right thing to do. You've now got investors, a whole variety of thousands of investors all voting with their pocketbooks and saying this is bad for business, bad for the economy, and ultimately bad for consumers.
Yeah, Steve, I know that you speak with a lot of business leaders. In your most recent op-ed, you talked about how those leaders were shrugging off tariff threats. Now that we have the tariffs, they're saying, okay, well, it's not really going to last long, so don't freak out too much. What is it going to take for executives to believe in the Trump administration's tariff agenda?
This may well do it. As I did write in that piece, and as executives were saying to me as I did my reporting and fact gathering, they simply didn't think that ultimately these tariffs would stay in place. And of course, maybe they won't. Maybe Mexico and China will come rushing to the White House and do a deal with Trump, one of his famous deals. We'll see. But yeah, certainly the fact that they're actually going into effect has to have some impact on business leaders and their belief that the Trump administration is simply prepared to drive the economy off the rails if necessary for whatever bizarre reason Trump has of the sort of 19th century mercantilism.
Steve, how quickly will we start seeing this reflected in the economic data? When we talk about the risk here of this weakening U.S. economic growth, clearly that is becoming more and more of a concern here for investors. We're seeing that reflected in some of the most recent sentiment data that we are getting. So I guess how quickly will that then filter through?
Well, the sentiment and some of the other numbers that have come out have already filtered into the Atlanta Fed's GDP Now figure, which I'm sure you've reported on, that essentially, instead of showing modest growth in the first quarter, now shows an actual contraction in the first quarter. I would caution the Atlanta GDP Now numbers are a bit squirrely. I'm not sure they're the best predictor of events that actually haven't even yet happened. We haven't even finished the first quarter yet, but it is certainly a worrisome sign. You mentioned a minute ago the decline in Treasury yields. And I know that obviously we all want interest rates to be lower rather than higher, but Treasury yields are not coming down because people are more confident about inflation coming down. They're coming down because they're more worried about economic growth coming down. And so that's also a worrisome sign, regardless of what the Treasury Secretary may say. So look, the economy is in the later stages of a pretty substantial expansion recovery since COVID. And these things get long in the tooth on their own. But what's going on in Washington is not helping things. And so I think you're going to see fairly weak economic data over the next period of time.
Steve, how unfriendly is the environment right now to businesses? And then I guess when we talk about the global implications or ripple effects of that, how do you see this playing out?
Well, it depends what you mean by unfriendly to business. I think one of the things that business, as I mentioned in my op-ed piece, is certainly looking for from the Trump administration, has gotten, is a much more business, in general, a much more business-friendly approach to particularly to regulation. Taxes are essentially set for business, so it's really about the regulatory environment. Obviously, the tariff thing cuts the other way. That is something business doesn't like. But most of the rest of what the business community has been hearing from the Trump administration, it actually likes. And so it's going to be a question of whether the bad parts of this outweigh the good parts of what business is getting. To
what extent are you hearing executives say they're putting expensive decisions on hold while they wait for policy clarity?
I can't say I know I've heard that much of that. Big capital projects take a long time to both formulate and then to implement. And you've seen in recent days things like the TSMC announcement of the investment in the U.S. You've seen Honda say that they're going to bring some car production back to Indiana from Mexico. So I think business is continuing to go about its business, so to speak, although I'm sure there are people who are waiting now that this is actually happening to see how it all plays out.
Mm-hmm. Steve, is President Trump losing the confidence of CEOs? Did you get that sense through your reporting?
Look, this is a very fast-moving story, as we say in the journalism business. And what I was hearing a week, 2 weeks, 3 weeks, a month, consistently since the Trump administration took office, it's hard to say today, after what's happened in the past week, that business still thinks exactly what I said that they thought. I do think business people care about things besides their own business. And therefore, what is happening in Ukraine, I know, is deeply disturbing to many of my business friends. The tariff thing is certainly a big factor. And it's just a question of when the bad starts to outweigh the good. As I said in my piece, the animating force behind the business community's support behind the Trump administration was, to a considerable extent, its antipathy toward the Biden administration, which it really restrained itself from talking about while Biden and Harris were still in power, because they might have stayed in power had they won the election. Now that they're not in power anymore, they're much more open to saying that. And so as far as the Trump administration is concerned, we're just going to have to see, as I said, how long it takes for either the bad to outweigh the good or for business to get comfortable that the good is going to outweigh the bad.
I wonder, too, how much the people you speak with are weighing the Fed versus the Trump administration and who will blink first when it comes to the market's negative reaction to the totality of policy, both fiscal and monetary. What are you hearing on that?
I think people want the Fed to keep doing what it's doing. I think there's, even though Jerome Powell's tenure has not been perfect, he did add to the inflation post-COVID. And he did have to cut interest rates after raising them in 2019. He's really he's done a very thoughtful, pragmatic, data-driven job on balance. And so I think there's a lot of confidence in the business community about him. And I don't think the business community is looking for him to rush out and cut rates when inflation is still at 3%. He's made a commitment to get it to 2%. And I think the Fed would lose a lot of credibility if he started cutting rates right now on these signs of economic weakening. So I don't think the business community wants or expects him to start cutting rates now. I think they expect him to finish the job of getting inflation back to 2%. And then hopefully there'll be some scope to cut rates.
All right, Steve, we got to leave it there. Thank you so much for joining us. We appreciate it.
Thank you. Bye-bye.
Stocks extending those declines today amid escalating trade tensions. President Donald Trump's 25% tariffs on Canada and Mexico. Also, that additional 10% tariff on China, all taking effect today. Risk-wary investors avoiding these market pullbacks amid heightened uncertainty. For more on this, we've got Andy Reid, the head of investor behavior research over at Vanguard. Andy, we were just speaking with our last guest about how quickly investor sentiment is moving in this policy uncertainty environment. What are you hearing from investors about the degree of pessimism right now?
Yeah, I would say, if the theme of 2024 was steady optimism, 2025 is really shaping up to be one of really rising anxiety. So we've been tracking investor sentiment over the last 8 years with a bi-monthly survey. So every other month, we ask about 2,000 investors to predict returns in the market, to predict GDP growth and inflation expectations. And in the last few months, we've really seen a sharp downturn in sort of pessimistic outlooks compared to what we saw for all of last year. And so really, it's a story of investors being on edge. So they haven't lost their nerve completely, but they seem to be a lot more anxious than they were for all of 2024.
Is it likely to be a bumpy ride for the weeks and months to come?
It's tough to say. I would say sentiment is quite fluid, right? It changes with mood, it changes with, front page news, with tweets, et cetera. The good news, though, is that portfolios are fairly robust. And so the relationship between changes in sentiment and changes in portfolios among at least Vanguard investors is not quite as strong as you would expect. So portfolios, in other words, are showing a lot of resilience in the face of changing expectations. So despite what you might expect, even though investors are becoming a bit more pessimistic in their outlook about the market, the economy, and inflation, their portfolios are largely staying the course. So, this notion of, everybody's panic selling, what we see in the data is that investors are not only much more likely to be buying the dip versus selling during choppy market movements, but by far the most common course of action is to simply stay the course. So on any given day, we're observing somewhere between 97 and 98% of Vanguard investors not making any changes to their portfolio.
That's interesting. So I was thinking before you said that about is sentiment going to catch up with the market? Is the pessimistic sentiment that we're seeing going to catch up to where the market's at, or is the market going to crash down to sentiment? It sounds like you're not seeing a reallocation that would indicate that.
No, we're certainly not. And I would say historically, what's fascinating about the patterns in our data is that the market seems to drive sentiment more than vice versa, which is to say, when we look at changes in sentiment over time, so if we look back to 2022 or 2020, for example, the market moved first and then sentiment changed in reaction to the market. What's different this time around is that the market was hitting its all-time high in roughly mid-February, and at the same time, investor sentiment was moving in the opposite direction. So sentiment was kind of moving ahead of the market, and I think what we've seen in the last few days is not necessarily unexpected, given that investors seem to be bracing for bad news and not simply reacting to it.
All right, we got to leave it there, Andy. Thanks so much for joining us. We appreciate it.
Thanks a lot.
Before we head to break, we want to bring you some breaking updates coming from Mexico's President Claudia Sheinbaum. She says legal action may be taken in response to U.S. tariffs. And if tariffs remain, Mexico will seek other markets for avocados and other products. We're going to bring you the latest updates as they continue to cross on this news, with much more ahead on Catalyst.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of this session. Do it all, Yahoo Finance's trending tickers page. First up, let's take a look at Best Buy topping fourth quarter expectations, but it did warn of some impact from tariffs. The retailer CEO saying that price increases are likely to be passed on to the consumer as a result of the new tariffs that are being implemented. Joining me now, we want to bring in Seth Basham. He's Wedbush Securities equity research analyst. Seth, it's good to have you here. Seth, talk to me just about the results and some of the commentary that we're getting out here from Best Buy's CEO. Obviously, same-store sales rising for the quarter, snapping 12 quarters in a row of negative growth. That's obviously looks like maybe we have turned a corner. Are tariffs going to reverse that?
Most likely they are, unfortunately. The uncertainty caused by tariffs is leading consumers to pull back on big ticket discretionary spending. You're seeing that in consumer survey data, sentiment data, and we think that Best Buy sales will likely decline again in the first quarter and potentially for 2025 if the tariffs really stay in place here.
How likely are you thinking that might be, Seth? And what are you looking at in your models and changing in your models to try and suss out the longevity of tariffs?
Yeah, certainly. When we think about the impact of tariffs, it really comes down to how much in terms of the rate and then how long they stay in place. Now, assuming that the 20% incremental on China stays in place as proposed, and the 25% on Mexico and Canada, we think there could be over 3 percentage points impact on sales growth for the next year for Best Buy. That would take them down to a negative low single-digit comparable store sales growth rate. So it's a pretty material change from their guidance of up 0 to 1% for 2025 ex tariffs.
I guess, Seth, what does that then tell us about the pricing power or lack thereof that Best Buy has at this point and their ability to pass on some of that pricing, the increase in pricing here to consumers?
Unfortunately, given the big ticket discretionary nature of the consumer electronics category, pricing power is more limited than other areas that I follow, such as auto parts. Consumers will pull back on those discretionary purchases most, and therefore companies like Best Buy are going to be faced with the decision of how much to lower prices or invest in price, so to speak, at the impact of margins in order to sustain market share gains and sales growth. So it's really a catch-22 for them. We do expect some price investments as tariffs roll through their P&L.
How do you rate Best Buy's attempts at front-running any impact of tariffs? Do you think that they should have been doing more in terms of stockpiling, especially ahead of this earnings print?
Well, we have seen their inventories grow a bit faster than sales, so they are stockpiling a little bit. But given the level of uncertainty, there's only so much that you can do out there. So I'm not too concerned about that. Best Buy has been through the tariff scenario before. They've had a good playbook before in 2018-19 timeframe. It's only modest impact on margins, but this time is different given the potential magnitude of the tariffs and the less healthy consumer environment that we find ourselves in.
Yeah, really interesting to hear you call it a less healthy consumer. That's the big question of the moment, Seth. Thank you so much for joining us. We appreciate it.
You bet.
We're also watching European auto stocks today falling as U.S. tariffs of 25% take effect on imports from Canada and Mexico. Yahoo Finance's Praz Subramanian joining us now with more on the impact. Praz, I know you've been following this closely. Help us contextualize what these tariffs actually look like for people purchasing cars. What do we know about the kind of end consumer impact?
It's not going to be good, right? You're not going to be happy about it. So, the new tariffs taking effect today, as we know, for products made in Mexico and Canada. But European automakers are now sort of in the line of sight here because Trump has threatened them in the past with the tariffs on these expensive European automobiles that he sees are a threat to U.S. production here. But these European automakers also have production in Mexico, right? Volkswagen makes the Tiguan SUV there. Volkswagen's Audi group makes a few cars there, and BMW has a big plant in Mexico. They make the M2, which is the car that's near and dear to my heart. Okay, so this is a problem for them, not just from a European tariff point of view, but also just these North American tariffs. And we had a study out yesterday talking about how Anderson Economic Group found that a certain crossover EV would cost $12,000 more. That's made in America because of all the different parts that are coming in from various parts of the country of North America that are tariffed, and $8,000 for a pickup made in North America. I mean, that's Trump country, right? That's a big deal. That's a lot. You asked about contextualizing. That's a pretty big price hike. All of it is not going to be passed on to the consumer, but most of it will be.
How quickly will the consumer see that higher price tag?
I think
right away.
I think we're going to see that pretty soon. If this, I know that the implementation of the tariffs is happening now, and there's cars that have already been made. There's parts that have already been imported that the automakers can use to build these cars. But in a few months, yeah. potentially.
What do you think, just from the sourcing and reporting that you've been doing, just the impact that this is going to have on sales? And how big of a risk that is, just given the fact, and we talked about time and time again, just the weakening consumer and consumer sentiment obviously right now is declining and posing a huge risk here to the sector at large.
Right. And cars are the elastic demand product, right? Even a small increase in price can knock down sales, right? And I've heard anecdotally people come up to me talking about what car should I buy now before tariffs go into effect? Because even used cars, right, that are made here and they're sitting there for 10 years old, they're going to go up because everything goes up. And those cars will be more sought after because they're supposedly cheaper, but they're going to go up too. So everything will be rising in the auto world based on these tariffs.
What is your answer to that question that people ask you?
I mean, I say, yeah, you should do it now. If you find a car you like and it's...
Get a car now. Used maybe is better than...
Right now, but it's changing.
I'm laughing because I personally have asked Pras all of these questions.
No, and we saw last month used car prices were ticking higher, in an unseasonable time. Usually a time when they're lower, they're ticking up higher. So it's already happening.
All right, Pras, a lot for us to think about here. Pras, thanks so much for breaking it down. All right, let's take a look at Apple. Apple introducing a new iPad Air. The company is saying that it's a faster and more powerful model built for Apple Intelligence, a tablet coming in at 11 inches and 13-inch sizes. Now, it's expected in stores next week. Apple's iPad revenue climbing 15% from a year earlier in its fiscal first quarter, which the company reported last month. So they're seeing some momentum here. Questions about whether or not the debut of this faster iPad Air is going to be enough to sustain some of that tablet growth. But again, there is some excitement surrounding these new products. And we know, obviously, the product pipeline very critical here to Apple as they try to boost demand for their all-important iPhone here, Maddie.
Yeah, and it starts at $599 for the smaller model, so not the most expensive offering from Apple. You've got your mid-tier at $799 as well, coming in a couple of colors here. Apple saying that the chip that's powering the iPad Air here is twice as fast as the previous M1 powered Air chip. So those are older devices, but just in terms of consumers comparing them, is perhaps a little bit faster here. It's going to be really interesting to see the success of this. I don't know people who have iPads anymore personally, but that's obviously
kids
anecdotal.
do, yeah.
Kids have iPads.
Kids have iPads.
And they love them.
My kids have the cheaper Amazon Fire tablets, but a lot of kids
we got to train them on Apple Intelligence, you know? We got to get them AI up.
Thought.
Yeah.
It's a very scary thought, believe me.
Something for you to contend with ahead of baby number 3. All right, we're going to be back with all of your markets action ahead, so stay tuned for more. You're watching Catalysts.
We're looking at a live shot right now from Ottawa as we await comments from Canadian Prime Minister Justin Trudeau after Canada just announced 25% tariffs on more than $20 billion worth of U.S. goods. Now, that announcement was in retaliation to the new tariffs that went into effect shortly after midnight from the Trump administration. Nearly $130 billion in U.S. goods will be impacted by China and Canada's retaliatory measures. Joining us now to discuss what's at stake and the escalation in the global trade war here, what this ultimately means for the U.S. consumer, we want to bring in Justin Wolfers. He's a University of Michigan professor of economics and public policy. Justin, it's great to have you here on Yahoo Finance. Just talk to me just about the implications of this escalating trade war, what it ultimately means here for U.S. economic growth.
Right. So there's two sets of issues here. There's the tariffs that the U.S. has put on the rest of the world. Those tariffs, to be clear, are actually not tariffs on the rest of the world. They're tariffs on Americans. When you go to buy a washing machine from Home Depot has imported that washing machine from abroad. In order to clear customs, Home Depot now has to pay tariffs on that washing machine. Home Depot, simple law of economics, when costs go up, you jack up your prices. Home Depot is going to jack up your prices. So you and I and all your viewers are going to see higher prices for the goods that you buy from Mexico, Canada, and China. That's 2/5 of our imports. That includes a lot of the fruit and vegetables that certainly my family eats every week. Then there's the tariffs that are in retaliation. Each of these countries has already announced retaliatory tariffs. That says that the global marketplace that has historically been open to American businesses, where we can produce the best stuff in the world and sell it all around the world, is starting to become closed. Look, we've seen this movie before. This was the first Trump tariffs under the first Trump administration. China put retaliatory tariffs on American farmers And it didn't take long before they went to the White House asking for payouts in order to help them struggle through what have become very difficult business conditions. So we're going to pay more at home. They're going to struggle to do business, and in a couple of months, you'll be looking to see American taxpayers bailing out American companies that have been hurt by these White House actions.
So, Justin, who do you think is going to blink first, the Fed or Trump, when it comes to especially the market reaction to some of this tariff news and the potential that the market is going to erase all of the post-election gains that we've seen?
So, to be clear, the US stock market today, measured by the S&P 500, is at a lower level than it was the day before the election. That's the US stock market judging that the current administration is less good for the future profitability of American businesses than they thought the day before Election Day. And this is despite the very large tax cuts promised by the administration. So it's a very sharp vote of no confidence. I don't think that this is a question of who's going to blink. It's not a strategic interaction. Canada's not trying to get us. They're not trying to knock us out of any particular market. They're doing exactly what we all thought we'd agreed to do with NAFTA, which is coming together to see if we could produce more together than we could apart.
Right.
They went through the circus
Justin,
renegotiating it.
Just to be clear, sorry, I mean, is the Federal Reserve going to potentially react more quickly to any market negativity that we're seeing than the Trump administration?
I don't think so. The Federal Reserve partly wants to stay apart from politics. Also, at the moment, we haven't yet seen any impact on growth. It'll cause growth to slow. That would normally cause the Fed to cut interest rates, but it's going to cause inflation to rise. That would normally cause the Fed to raise interest rates. So it's a very difficult balancing act. But I don't think of the Fed as being a particularly major player here. We do know that the president historically listened very closely to what financial markets were saying. Financial markets are saying they hate his latest actions.
You know, Justin, I'm curious just in terms of some of the recent data and some of the trends that we are seeing. And Sam Rowe of the Ticker, in his post this morning, reflected on a chart that Morgan Stanley recently published, if we could pull that up. And they talked about on earnings calls. They did an analysis right now of earnings call transcripts. And they were talking about the pull forward mentions that we're starting to hear and that we have heard from a number of companies here over the last several weeks. And we have seen that number tick higher here in the most recent quarter. I guess my question to you is, ultimately, what impact does this have on the economy? To what degree is this really moving the needle, if at all?
Right. So there's a very weird short-run thing that's going to happen, which is we all knew tariffs were coming. And so some of the more sophisticated players realized, let's get in there and buy. You know, I had neighbors who bought their family car in January rather than waiting till March. But more than that, we've seen businesses that need raw materials really pull forward a lot of their spending from what would have been March and April into January and February. In some sense, by the way, this means that the Trump economy began before he actually came to power because people understood what he was going to do. So that has led to a very sharp surge in imports in January. We've got the early data on that. In February, we're going to see an even sharper surge. The US trade balance blows out. And that's going to have all sorts of weird effects through the rest of our economic measures. So my advice to your viewers is be very careful about interpreting economic data over the next few months, because you'll see a huge surge in imports followed by a huge decline in imports, both of which are basically due to trying to front run the imports. And that's going to have effects all through our economic data. And it's actually going to be several months until we see what the underlying shape of the economy really is.
So how does that viewpoint impact your thesis about where we're at in this economy, Justin? And how should our viewers be thinking about how much weakness there is in this economy? Is there significant, substantial weakness? Are we in the middle of a slowdown? How would you characterize it?
So I think I'm an optimist. The president inherited actually a remarkably strong economy. We have unemployment very low. We have inflation around about 3% and heading back down to 2%. We have the Fed on a path back to normalization. We have reasonable rates of economic growth. So before January 20, I was thinking to myself, wow, this all looks pretty good. And that's basically the answer I want to give you. The problem is a lot has happened since January 20. There's two shocks in particular I want you to keep your eye on. The first is if you look at measures of economic uncertainty. They're at almost record highs now. The pandemic actually caused higher levels of economic uncertainty, but beyond that, we've never seen uncertainty like this before. And if you were the CEO of a major business thinking about breaking ground on a new factory or purchasing new robots or overhauling your software, you might think to yourself right now, amidst all this uncertainty, you know what, I'm going to wait 3 months to see how all this pans out before I start spending money. Now, if enough factories do that or if enough families do that, that creates its own economic problems. And then the second thing we're already seeing is consumer and business sentiment have really cratered over the last couple of weeks. What the president has been doing has been immensely unpopular. The American people don't believe that this will be in their best interests. And the real question for the economy is, people say they don't like it. Are they going to act that way? If so, they're going to pull back on their spending. And if that's the case, that could be the first shot fired in something of a downward spiral. And I'm very worried about that.
And on the topic of consumer spending, we're just pulling up a chart of that Moody's study that I know you've heard about from this week. The top 10% of earners are making up half of consumer spending. What impact does that dynamic and that wealth gap and spending gap have on the economy if it continues?
Look, the economy's not some weird third thing that's out there. It's you and me and our lives. And if a small number of people get to do half the spending, that means a smaller number of people get half the stuff. And that means there's less stuff for the rest of us. It's as simple as when we have enormous inequality like this, that suggests there are many families that are doing without. And the only ways to help those families are to grow the pie and to grow the size of the slice going to those folks. And they're the two ways forward, and I'm not sure which of those is the Trump administration's current goal, because it appears to be serving neither goal well.
All right, Justin, thank you for breaking it down for us and joining us. We really appreciate your insights. Thank you.
A pleasure.
Before we head to break, we want to go live to Canada. You're looking now at a live shot as we await comments any moment now from Canadian Prime Minister Justin Trudeau in response to the U.S. tariffs imposed on Canada today. We will be monitoring this for any updates, and we'll bring you that news as we get it. We'll have much more coverage ahead on Catalysts. CoreWeave, one of the hottest names in AI cloud computing, is going public. Backed by NVIDIA, this once small startup is now eyeing a valuation of over $35 billion. Founded in 2017 as a crypto mining firm, CoreWeave then pivoted to AI cloud computing, riding that explosion in demand for those high-powered chips that train AI models. In 2024, the company brought in $1.9 billion in revenue, a huge jump from just $229 million the year prior. But with that growth comes losses, $863 million in losses last year alone. Now, CoreWeave's big-name backers include NVIDIA, JP Morgan, and Fidelity. It even secured a $650 million credit facility from top banks like Goldman Sachs and Morgan Stanley. However, the company does rely heavily on just two customers. One of them is Microsoft. They accounted for nearly 2/3 of CoreWeave's sales last year. Now, CoreWeave is set to trade on the NASDAQ, ticker symbol CRWV, with Morgan Stanley, JP Morgan, and Goldman leading their IPO. Some of the company's challenges. CoreWeave did disclose weakness in its financial controls, and its rapid expansion means high costs and potential growing competition. But still, as AI adoption surges, CoreWeave is positioning itself as a leader in the cloud infrastructure space, making this IPO one to watch, even amid growing concerns about IPO pipelines more broadly.
Well, IPOs this year raising $6.6 billion, with 48 companies filing to go public so far. Now that's an increase of nearly 60% compared to a year ago. That's according to the latest data out from Renaissance Capital. For more, we want to bring in Brianne Lynch, Equities and Head of Market Insight. And Brianne, we certainly are seeing some volatility on the rise here on the heels of the tariffs that were just announced by the Trump administration. I guess my first question to you is ultimately, what does this mean here for the IPO landscape? Is this a risk here of potentially slowing down some of that deal momentum?
Great to be here. And, we entered 2025 expecting this to be a big year for IPOs. And a lot of the things that have happened in the market over the past few weeks are adding concerns for investors. So tariffs, you mentioned, concerns about inflation and the fact that we might not actually see rates come down in the near future are all things that are weighing on that investor sentiment. And the early IPOs we've seen as well haven't really given a vote of confidence for other companies to follow. You have Venture Global trading down about 40% from its IPO price. SailPoint IPO'd last week about flat. So I think a lot of investors are hoping a big tech company like CoreWeave could be the one to reverse that trend, because certainly we're not seeing strong IPO traction yet.
How has that conversation and I guess changed from the companies that you speak with? Was there a little bit more momentum following the election results that you've seen slow down in recent weeks?
Yeah, there definitely was a sense of momentum that we were seeing in the market, and it's been building over the past 2-3 years. Globally, you have over 1,200 of these unicorn companies, so companies valued at $1 billion that have been waiting for their next move. And for many of them, that's an M&A event or an IPO. And, I think many thought that we would see more M&A given more of a risk appetite and allowing more M&As to happen, less antitrust. But that's something that hasn't really panned out. And IPOs, given where the market is still a bit shaky. But I think for a lot of these large companies like CoreWeave that are generating a ton of revenue and growing, they have opportunities to grow in the private markets, and many are choosing to do that while they wait out the volatility.
Brian, what does investor confidence look like here in these newly public companies?
Yeah, I'd say in newly public companies, we've seen a little bit more investor trepidation. It's more of a risk-off appetite than we had expected coming into the year. So investors are a bit more cautious than maybe we had anticipated. But there still is this growing demand to participate in the innovation and growth that is changing industries. So when you look at AI companies in particular, a lot of these companies are growing so rapidly, like CoreWeave, in the private markets, that investors that are looking for that growth and looking for a little oomph in their portfolio are moving to the private markets and saying, hey, I'm not going to wait till the IPO. I'm going to invest earlier because it's questionable when these IPOs might happen.
Yeah, that's really interesting. I wonder, too, if you can talk about how we're seeing that play out from a global scale. I know we've seen this trend of companies transferring their listings, coming to U.S. exchanges from foreign. Do you think that could potentially be a bigger pipeline than new companies, new IPOs getting listed on U.S. exchanges?
Yeah, I think there is an opportunity there. The U.S. market is, the largest financial market, in the world, and market that investors and companies are looking to, participate in and, be in front of U.S. investors. So I think that's one component of it. But I think more broadly, we're going to have to see, a little bit more macro certainty, or a few IPOs do exceptionally well before more companies will decide where they want to play their pieces.
Brian, for investors out there, our audience is trying to figure out where we're going to see most of that activity. Where do you think it's going to come from?
When we look at companies on our IPO outlook, there were a few main categories they fell into, cybersecurity being one, hardware like CoreWeave falling into that AI infrastructure play, and then fintech companies as well. So those are some of the key categories we're looking at. Klarna is a company that's filed their S1 planning to go public, and they fall into that fintech bucket. You've got CoreWeave again in this AI infrastructure bucket, and then cybersecurity companies being another one that's a big focus area.
All right, Brian, thanks so much for breaking that down for us. Appreciate it.
Thank you.
Let's do a quick check of the selling action that we're seeing across the board here. You've got the Dow, S&P, and NASDAQ all in the red. Once again, you have the NASDAQ in correction territory, off just about 1.5%. We're seeing the sell-off extended from yesterday. Now, when you take a look at some of that concern creeping into the market, obviously on the heels of the newly implemented tariffs from the Trump administration, rattling investor confidence here for a second day in a row. You now have the Dow off just over 750 points. The S&P losses of 1.7%, where again, one of those critical levels to watch, one of the next critical levels to watch, as Maddie pointed out earlier in the program, is 5,700. When you take a look at the move to the downside here, we have wiped out those post-election gains when you take into account ultimately what this means maybe for that trade moving forward. Of course, the question that so many investors that we have been asking strategists here this morning is whether or not some of that selling pressure is over. Nancy Tangler telling us earlier in the 9 a.m. hour that we could have another 5% or so to go, just depending on the developments, the retaliatory measures that we're expected to continue to get here. Again, Mexico expected to announce that in a couple of days. We're also waiting the latest reaction from Canada's Prime Minister Justin Trudeau. He is expected to speak any moment right now, so we will bring you those headlines as they cross. If you can flip it over to the bond market as well, we're seeing this move lower here in yields. You now have the 10-year yield as well as the 2-year yield hitting the lowest levels that we have seen since at least October. You have the 10-year yield right around 413, 414 now, off another 4 basis points. Keep it right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Worries over a global trade war and a drop in optimism over that U.S. crypto reserve, they are weighing on Bitcoin and the crypto trade writ large. But just how far might Bitcoin fall? I'm Jared Blickery, host of Stocks in Translation. Let's take a look at what the technicals are telling us about Bitcoin's potential next stop. So I thought we'd get back to basics here and just review the definition of a trend. This is very important. A bullish trend is a series of higher highs and lower lows, while a bearish trend is a series of lower highs and lower lows. And I'll also add that the market can go sideways, frustrating traders, breaking out to both the upside and to the downside. But first, let us establish the longer-term trend in Bitcoin, and that is up. This is a 3-year chart. So we take this low here from about the beginning of 2023. We can just kind of eyeball and see that it's zigzagging up and down. But critically here, we have higher highs and higher lows. And if we were to pivot right here, you might think, well, we could go higher, but we also have to consider the converse of that. If Bitcoin now falls below, what is that, about 50,000, then we have a series of lower lows. And if you look at the short-term time frame, this is going to really be illustrated because over the last 2 months, I'm going to put some candlesticks on because it's kind of important to the presentation. It might be a little bit hard to see, but I'm going to draw in these trend lines right now as I see them. So here we have a low, here we have a high, here we have a lower low, and a lower high, and this brings us to where we were 24 hours ago or thereabouts. That was when we were looking at the crypto reserve news, really just catapulting crypto and Bitcoin to higher prices. However, as you can see, we are in the midst of a short-term downtrend, and this has important implications because what happened yesterday, I'm going to draw a line right here. If you take this high over here, and this is the ultimate high of Bitcoin, 109,000, and then you take this low here, it's about, I don't know, that's 70 in the, I'd say about the low 80,000s. You take that, we have a 50% retracement. That is the midline here. And then we can put a target down here. It's a negative 23% retracement. I don't want to get too wonky here, but this target sets up for about 71,000, 70,800 exactly. And you combine that with the price action support that I was noting the other day, and let's get that in here. This is a volume support. That's what we see here. These are transaction areas. This area right here marks a very important price action potential support. That is right around 70,000 as well. So that gets to my ultimate thesis that Bitcoin right now is probably heading toward the low 70,000s, at least before it gets to new record highs. So on that note, tune into Stocks in Translation for more market decoding deep dives and episodes every Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared Blickery, thank you so much for joining us. We appreciate it. Let's get a check back in on the markets, especially the selling that we are seeing here. You've got U.S. stocks reversing and continuing their losses here. You've got the S&P 500 down about 1.5%, the tech-heavy NASDAQ carrying those losses here. One thing I think is really interesting as the S&P eyes its 200-day moving average. If it hits that level, we could see more selling. I think the sequencing really matters. This is something I talk about a lot on Capital Gains, our politics show. In 2018, we had corporate tax cuts first. This time around, that is not the case. Also, corporate tax cuts are somewhat priced in at this point. They're just going to be a continuation. So even if we do get those tax cuts, will that relieve the pressure that we're seeing on markets from these tariffs? That, of course, is a big question that remains to be seen, Seana.
Yeah, certainly. When you take a look at that 200-day moving average, Maddie, some of that selling pressure, you're right, the sequencing clearly being reflected in some of that concern that we are seeing creep into the market here, or has been started to creep into the market over the last several trading days. But again, when you have the S&P right around 57.64. That critical level to watch here, 200-day moving average, 57.25. And why? Like you said, it could accelerate some of that selling there. So again, that's important to keep in mind. And of course, this comes as investors and strategists question a Trump put and whether or not, what level the S&P could potentially need to fall to in order for Trump to blink here. So we will see. Very much up for debate. All right, coming up next is wealth. Maddie has you for the next hour.